So just so you know, I have the speaker going, so we have to curtail any four-letter words that could get back to the president. But what I'm hearing you guys did is you went through some of these, the understanding of retained earnings is really an account that continues to accumulate the earnings or losses from a company minus the dividends that they paid out over the period of time. It's part of the stockholders' equity section, isn't it? Do you guys know what a stockholders' equity section is? Have we talked about that yet? And then the chapter starts discussing various types of dividends. The most common is cash dividends. How many of you guys have owned stock and received a cash dividend? Okay? Now, there are some companies, such as Apple, that hardly ever pays a dividend. How can they get by with that?
They keep reinvesting the money in new products and R&D.
They keep reinvesting the money, but the stockholders aren't making any money, or are they?
They will in the end.
In the end, the stock price becomes more valuable, the stock raises. So there's different philosophies on dividends. Some companies are known for paying dividends, such as utility companies. So like my father, who's 87, always invests now in utility companies because their stock price remains fairly stable, but they pay out a significant dividend for a retired person that helps them, provide some income for them. So various companies have different views on dividends, but those that do, the most common is a cash dividend. So you guys discuss the various dates, okay? And then the next is property dividends, which do not occur very often, but that is something that can occur. Property dividends. Scrip dividends are basically a promissory note. I'd want you to know that a scrip is basically a promissory note. Get it? Get my hint? Yeah? Know that a scrip dividend is, what's a scrip dividend? It's basically a promise to pay a dividend in the future. Okay? And then stock dividends are fairly common. So when I tell you this, cash dividend is the most common. You'll probably have some multiple choice on a cash dividend. I'm telling you, don't worry about property dividends at all. I'm telling you, probably know that a scrip dividend is a promise to pay a dividend. And then stock dividends are pretty common. So I'll let you know even as I'm talking, things you in your head can go, don't need to worry, because I would rather you focus on those things that matter. Make sense? Did you talk about stock dividends? So stock dividends, the interesting thing with stock dividends, does it really provide you with anything more? From a pro rata share, say, of stock, they normally will provide you with a stock dividend, but the ratio still kind of stays the same, doesn't it? Do you guys know what I'm talking about? So if a company grants a stock dividend, it's basically not cash per se. They're adding more stock to the pile. But what are you getting? Additional shares. Does it ultimately lower the value of the stock? It doesn't lower the value of the stock? I'm going to do a problem on stock dividends. It does affect your retained earnings, but it basically there's a pool of money, and issuing more stock is just spreading out the stock on a greater level. We'll talk about that. But guys, there's a psychological benefit to having more stock. And it technically works. You know, like stock splits. There's something that really works when Best Buy or 3M has a split. Excuse me about Best Buy. That's not a split. That means they just go down. But 3M, when they do a split, for some reason, lowering that price just automatically raises it again. It's kind of an interesting psychological, doesn't make sense, but it works because at a certain price, people are more apt to buy more stock. Make sense what I'm saying? Any questions so far? Okay, so you talked about stock dividends. And accounting for stock dividends, we're going to go through problems. So sometimes that's the best way of understanding how it works. Where there's a par amount, what is the par amount of stock? Isn't it the initial price it was initially issued at? So let's just say Apple was initially issued at $5 a share. What's it at today? How many? 700. So that initial 500 is the common stock at par. The initial $5. Everything else gets put into the additional paid-in capital. So we're going to go through examples of how this shows up on the stockholders' equity section. Here's an example. Did you guys go over this? Okay. So, how do we adjust for prior period adjustments? Prior period adjustments have become a big deal lately with the Sarbanes-Oxley Act. How many of you are familiar with that SOX Act? Why do we have it? Enron and WorldCom and Tyco and who else? And so, but has it made anything better? That's debatable. The jury's still out on that one. I don't know. But as a result of Enron, they've really honed in on corporations and responsibility. And as a result of the Sarbanes-Oxley, it's amazing how many large corporations started going back and restating their earnings because they were scared to get their hands slapped. And so from the prior period adjustments show what happens when a company comes back and wants to restate some financial statements. So in this example, they talk about in 2014, Riker Corp discovers it inadvertently did not accrue $10,000 of interest expense. So if there's an income tax consequence as a result of that, you see that they've gone and debited their retained earnings. You know, past debited means reduce it. And they show the payable, and then they show how that the income taxes may be affected as a result of that. Do you see that? If Riker's January 1st, 2014 retained earnings balance was $102,400, it reports the correction at the end of the period as an adjustment to the beginning retained earnings balance. So again, we'll go through problems. If I talk about it, we'll worry about it. So the statement of shareholders' equity, am I where you guys are at yet? Did you go through this?
We did go through this.
Okay. So I think what I'd like to do is let's take the first 20 slides and let's work some problems to help you incorporate how this is going to play out. Now, one thing I will do is I will post on Moodle a template for you that will have a lot of this information filled in already, so when you're in here, you're not spending all your time writing. Those of you that have access to a printer and print out your own, it's awesome. I will probably bring about 15 of them to class, but if I print out 30 each time, I end up using this much paper, and the girls in my office get tired of stapling. I don't have one that staples it automatically, but I will for next week, have 15 to 20 of them. If you guys can print them out ahead of time, that's great, okay? And the key here is it just gives you more time to pay attention instead of writing up a storm. Make sense? Get it? Okay, so guys, the first problem, let's see. How are we doing? Everybody okay so far? Let's just look at this one, okay? I know this isn't your homework, but let's look at it, okay? Okay? So, I know what I need to do. I don't have an actual book. I only have the ebook. So I'm going to pull the ebook up for those of you. How many of you guys have a book in here? Most of you? Okay, so I'm just going to pull it up, so if you're reading online, sorry guys, I was too busy talking. How many of you guys use ebooks?
I do, but I usually print it off.
I
I
know.
like to have the paper.
There is something nice with having it. Okay, here it is. What page is it, this exercise 16.2 on? I'm sorry? 1642? It doesn't exist. Oh, 16 dash. Okay, exercise 16.2. Okay, can you guys, are we on the same page here? We good? Dividends, Andrew's company has $80,000 available to pay dividends. It has 2,000 shares of 10%, $100 par preferred stock, and 30,000 shares of $10 par common stock outstanding. The preferred stock is selling for $125 per share, and the common stock is selling for $20 per share. Okay? So our job is determine the amount of dividends to be paid to each class of shareholder stock. Okay? How are we going to begin this, guys? What are we going to do to start this problem? What do you guys think? Any ideas? The preferred stock, we need to talk about the par value. Okie doke. So, sorry, let me just figure this out. So with the preferred stock, the preferred stock is how many shares times 10% times $100? The dividends? The preferred stock dividends, you know how preferred dividends are the first to be paid and they have a set amount? Do you guys know what I'm saying? Common stock isn't that way, but preferred will always be the first to be paid. It's telling us that the 2,000 shares at $100 par are going to be paid 10%. So what are we going to do there? 2,000 shares at $100 times 10% is how much? 20,000, right? Can you guys see that? Can I make it bigger? I don't think I can make this bigger. View. How about I'll file, save as. Nancy, 16.2. There. Thank you. Okay. So we know the preferred dividend is at 20,000. How much does that give us left to be paid to common stock? How much? 60,000 is what's left for common stock. How many agree with that so far? Do we know how many dividends are in arrears here? Andrew's company has 80,000 to pay. It has 2,000 shares of 10%, $100 par preferred stock, and 30,000 shares of $10 par common stock outstanding. Each class of shareholders for each of the following. Okay, we need to determine the amount of dividends to be paid to each class of shareholders for each of the following independent assumptions. Preferred stock is non-participating and non-cumulative. What does it mean if something isn't cumulative? there's no arrears. So in A, for Part A, we would pay $20,000 in preferred dividends to the preferred stock, and the rest goes to the common stock. Does that make sense? How many of you guys get that? Okay. B, the B set says preferred stock is non-participating and cumulative. Preferred dividends are 2 years in arrears at the beginning of the year. So what does that mean we need to do, guys? Dividends in arrears, they're 2 years in arrears, right? Is that right? So 40,000 is in arrears. We would have 20,000 right now, which would give 60,000. How much does that mean we've got available for common? Does that make sense? Could you do problems like this? What are we learning here? The preferred stock makes it very clear what their guaranteed stock dividend is when they pay them. And you know, if they are in arrears, they're going to get all those arrears first, right? Now C states preferred stock is fully participating and cumulative. Preferred dividends are 1 year in arrears at the beginning of the year. So what are we going to do there for this one? What do you guys think? 1 year in arrears, right, would be 20,000. For this year, 20,000, right? And what does it mean if they're participating, guys? Do you guys know what that means? If it's participating, preferred stock is participating, they're going to share in with the participating means what the preferred stock gets, the common stock is going to get also. Okay? So if the preferred shares receive 20,000 each, or 10% of their value each, what is going to be the common stock value? How many are out there? What does it tell us? 30,000 shares at $10 par common stock. Do you see that? So if we look here, we would have 30,000 at $10 at 10% participating. So what the preferred shares do, we're going to do common stock the same. What's that going to be? 10% of 30,000 shares at $10 a share. 30,000. Now what are we doing? The rest we share between each. How are we going to do that? How much is going to get shared, guys? 10,000 is left to get shared. How are we going to share that? Okay, let's go down here and figure out how we're going to share this. If we have, excuse me, I can't type it there. The remainder should be shared at, for preferred, 2,000 shares. Here, let me open up another screen here. So we're going to have here 2,000 shares. At, okay, let me back up. We've got 10,000 extra bucks, right?
Yep.
We have 10,000 extra dollars we can use. How can I make this one bigger? You'll know that working on a computer is not my... Maybe I need to save this sucker also. There. Sorry. So we have $10,000 we're going to have to share between both of them, okay? So that extra dividend, we're going to calculate that extra dividend by determining, we have how many shares of preferred stock? 2,000. How much are they a share? $100 a share, right? And what we're going to do is we're going to divide all of that by the 2,000 times $100 a share plus 30,000 times $10 a share, okay, because that's our preferred shares. Those are our common shares, right?
Is that because it's participating?
It's participating. That's why we're doing this. Normally we wouldn't. It's been non-participating in the past. So they're participating in the additional dividend. See? That's a way you can remember it. If it's non-participating, preferred share gets their money and they're done. If it's participating, they get their share, then they're going to, the extra amount, the common stock's going to get the same amount, and then they're going to share that extra. So the 2,000 shares times 100 shares, or times $100, divide that by all the stock outstanding. It's going to, if you calculate that, so basically 20,000 or 200,000. Let's just figure this out. 200,000. We're dividing that by 200,000 plus 300,000, right? Or 500,000. Am I making sense? Equals $4,000, right? You guys get that? So we know, guys, that the amount that the preferred is going to get is 4,000, and the amount that common's going to get is 6,000. Make sense? 36. Now, guys, we could go back here and do that same thing. I could do the same thing for the common stock, and we're going to get the same results. 10,000, and then we would say the 30,000 shares times $10. Get what I'm doing? Divided by that is going to be 300,000 divided by 500 or 6,000. Do you guys get what I'm doing here? Yes.
So is this supposed to be 500,000 on the denominator, or because 300,000 divided by 500,000 is 6.
This is 0.6.
Instead of the 10,000 is 6,000.
Oh, okay. I get it now.
So it basically shows us what percent of that dividend gets shared for preferred and what gets shared for common. How many of you guys get what I'm doing here? Does it make sense? Does it help to do this together?
Yes.
I can talk on a PowerPoint and just, yeah, but then when you get the nitty gritty, it's like, yeah, I get it. Instead of being conceptual, it becomes practical. Got it? So does that make sense for you guys? Are we wasting time doing these, or do you enjoy doing these?
This is awesome. But wouldn't it be 44,000 on the other side? Okay, I just want to make sure I'm
64,000. What am I doing wrong?
The 20, 20, and the 4 adds up to 44,000 because the 2 should tie out to the 80, right?
I would like to tell you I did that on
Nope,
purpose.
it's all good. I just want to make sure.
But I'm not going to lie, because guess what?
We like the truth.
Let me tell you, if I don't have my calculator, there are going to be errors. Okay, when I had to take the CPA exam, you couldn't have calculators back then.
Wow.
And thank God you can't. Thank God now you can take one exam at a time, you know, or one part of it at a time. They make it so much more manageable now. So yes, if I don't have my calculator, you're going to have me. Okay, number 2. How are we doing, guys? I'm going to ask you that probably too often, and you're going to get sick of it. For 1A, compare the dividend yield on the preferred stock and the common stock. What the heck are they asking? What do they mean dividend yield, guys? dividends per share divided by market price per share. So how are we going to handle this one, guys? How are we going to do this? What is the preferred stock? 20,000 divided by 2,000, right? 20,000 is the, oh, stop it. Okay, let me go over here. Back to my sheet. For number 2, how are we going to figure this? We've got $20,000 in preferred stock. Divide that by 2,000 shares, right, for 1A, okay? So that basically divided that by how many dollars per share is it? 100?
The preferred stock is 100 and then the common is
20. It has 2,000 shares at 10%, $100 par. What's the preferred stock market value? 125. Thank you. So if we divide that by the market value, $20,000 divided by 2,000 shares divided by the market value, what's that going to equal? $2. Divide that by $20, or what's the percent? $2 divided by, $10 divided by 125, and that's 8% there. So what's the yield there? What's the yield on preferred? How are we going to do common? The same way, guys. 60,000, divide that by 30,000 shares, and we're going to divide that by the market value. And what's the market price right now? $20 a share. Do you see? The par value is that initial price it was issued for. But the par value isn't always the market value. It's very seldom ever the market value, isn't it? Do you guys get what I'm asking? But we're trying to find out how this dividend relates to today's market value. So if the market value is at $20 a share, then what are we going to do? $2 divided by how much? 20. What's this yield? Do you guys get it? The common stock yield is actually greater in this case than the preferred stock yield. Do we want to go back and understand how we did that again? So we're taking the amount of dividends, dividing it by the number of shares to come up with an amount per share, but then we're dividing that by the market value. Now we know the price at par was 10% because that's what it said. But at market value, it's 125, so it's going to be lower. Yet the common stock, we're doing it the same way. There's a lot more common stock shares, they're valued at less, but it's a higher yield per stock. So they're getting a 10% dividend based on the market value. How many of you guys get what I'm doing right here? Okay, I'm going to let you know something. We're spending a lot of time on this, so chances are you're going to see this again. Okay? And when I say that, if I ask questions like, how do you determine the yield on the dividend yield at today's market value? You'll be able to figure out how that works, right? Any questions on that one? Are we good?
Could you go back to the other Excel sheet for 1
Absolutely. And I'm going to be really rude and run to the restroom real quick. Do we want a quick break or not? Is that okay?
Yeah.
Can we take a quick break? Guys, is it too dark in here?
No, that's fine.